I heard everything on the internet is absolutely truthful and factual, but I guess you found something that isn't. So let's break this down.
So one of my friends sent me a TikTok, and I sit there and I watch the TikTok, and what the person's describing is genuinely illegal. Okay, so this gentleman is a wholesaler, and he said, hey, part of my wholesaling agreement is when I assign you a deal, Benji, what I'm doing is after you flip this property, you have to list it with me. So they are a wholesaler, and they're a licensed agent. Unfortunately, that's illegal. Okay, that's what's called a tying arrangement or a tying agreement. That's a violation of antitrust law. Now, most people don't know things like this, but this just really struck a chord with me this morning when it was sent to me. We look at the internet and we look and we go, you know what? This guy's good looking. This video's got a good pace. It's been watched 10,000 times. It's got, 900 likes. It's got a whole bunch of comments on it. And I read through the comments. This is brilliant. This is a good idea. Man, everyone should do this. And I go, this is blatantly illegal, but they don't know that. So my thought is as we're being real estate investors, as we're being business owners, and as we're thinking about things, and we hear something, and we're like, man, that's a good idea. Go double check it. Make sure that is a good idea. Prove it's a good idea by double checking it with maybe 3 other sources. When you read data, go check the data against 3 other sources. When you read an article, go check it. Be very careful of the dopamine from these shorts on YouTube and these TikToks, because we sit there and we just get the dopamine hit, but are we getting correct information? So that's what this was, man. It blew my mind. I was like, yeah, you can't do that. How often do we just accept everything, though, at face value?
A lot more these days.
A lot more these days than we should. And so, let's just do some due diligence. That's all I was thinking about.
In real estate, one thing that's important is context as well. Data may be truthful or factual, but the context will determine how it matters to you. How do people look at some kind of headline or real estate article and get context that applies to them?
When you read a headline and you get the emotion, we can't make the emotion go away. So let the wave pass. Now let the emotion calm down. Read the article. And as that article evoked emotion in you, think, well, the writer did a good job. Now I need to go, what does this mean to me? How does this relate to my goals? Does this actually affect me? Because what they'll say is they'll put up a news headline that rents are crashing across the United States. And as a landlord, you go, oh no, rents are crashing. Well, maybe nationally rents went down a little bit. And we're going to talk a little bit more about that later in this episode. But that doesn't mean rents are crashing. That's just the headline. And then they pulled some data. You need to then go check, okay, well, I live in the Seattle Metro. What's actually happening to rents in my backyard? What's happening to them in my market? Read a lot, watch a lot of videos, but then take it with a grain of salt and go verify that information.
Right. It's important to get multiple sources or have an agent like yourself, right?
Find someone who you know, like, and trust, who you could reach out to them and then send them this article or send them a text message about it and say, hey, what's your opinion on this? Because once we've built that relationship with your real estate agent, they can become that trusted advisor, especially one who digs into economic data like, we love to do. They're going to have a pulse for what's actually happening. And you know what? They may reply back and say, yeah, this is a great article. We need to figure this out, or we need to watch this piece.
Yeah, and the last thing I'd say, knowing a lot of these real estate channels, they know how to get a clickable title and thumbnail. They know how to get those emotions going, and ultimately they're good at making YouTube videos and keeping you watching. They might not actually have a lot of experience in real estate. They might not even care if they're putting the wrong information in you, because ultimately they're looking at the view count or the audience retention. So really digging in is important. Also with real estate, your local market is going to be the most important place to start from to build out the context of what these people are saying, even if they're talking about your market, because a lot of these people don't even live in your market and they're making these statements. We already know a channel that does this. It's like doom and gloom. He even said he took a break because he was tired of doing those type of videos, right? And then he started up again because guess what? That's what gets him the clicks. That's what gets him the views. So important to always like you said, take a step back.
Take a step back, feel the emotion. The emotion's real. But, you know, one that we covered on a previous episode was the massive Airbnb crash. That was a good headline, okay? Airbnb revenues are down, but is that causing the tsunami of Airbnbs to hit the market and crash the real estate market? Absolutely not. But once again, great clickable headline.
All right, so tell me about this San Francisco Fed article, because I did not see this, but it sounds like it's mind-blowing.
This blew my mind. The San Francisco Fed released an article and they titled it, "Where is Shelter Inflation Heading?" And it's interesting to see when different parts of the Federal Reserve, because it's made up of different banks, when they release something and talk differently about the market. So first off, what is shelter inflation? Shelter inflation is basically how much it costs to keep the roof over your head, whether you are a renter or a homeowner. How they look at that is they call it rents and owner's equivalent rents, aka your mortgage. And so that is what is used to make up about 30% of the consumer price index, rent and owner's equivalent rents. They also take it from two different points in time. They take it from today and then they have it rolling back in time. So it moves very slowly. But this is what they predicted and why it was so interesting. They predicted that rent growth is stalling across the United States. And then they said, and this is the kicker, we may even see deflation, aka prices going down, due to the surge in new apartment availability coming online from this new construction. This is the first piece where this shelter component, rent, owner's equivalent rent, where the Fed has actually said, wait a second, we may see some deflation happening here. And so my mind is like, well, our audience needs to know about this. We're real estate people, we're investors, okay? So what should we be doing right now as an investor in relation to this? If I'm putting together a pro forma, I need to look at what I'm projecting rents at over the next 1 year, 2 year, 3 year, and I need to squish it down a little bit. I need to be a little bit more conservative in my projected rent growth. Now, of course, like we just said in the previous segment, your local market's going to dictate these numbers, but be more conservative to protect yourself if rent starts to deflate. In other words, go down in price. And I know on the consumer side, we'd love to see lower rents. We'd love to see lower mortgages. As an investor, you can't predict future rents. It's a prediction. So if the Federal Reserve is starting to say, hey, wait a second, we might have an issue, just be cautious, be conservative, dial it back a little bit.
One thing, this is an anecdotal example, but a neighbor of mine, he was renting a 3-bedroom, 2-bathroom house, $2,800 a month, which is crazy. It's astronomical. I remember renting my first apartment in the area 20 years ago, $700 for a 2-bedroom, right? And that was split between me and my roommate. So $2,800 is crazy. But then he moved out, and that same house, I thought, man, I wonder what they're gonna ask for rent. $200 less. I was surprised by that, right? And that was way before this article came out, before there was these headlines. I just assumed it would be at least the same, if not more, because across the street, somebody was trying to rent out their house for something crazy. They probably didn't get it. But again, everybody was kind of trying to milk it, right? Get the most. This was the first example of a in-demand type of property, right? It's a standard family home, and the rent went down. So I wonder, and of course, that's just one example. Who knows what was going on? Maybe there was other costs that he was talking about versus what I saw on the rent site. But I believe, and I'm curious your thoughts, that I'm starting to see that. I'm starting to see that we hit the top of the rental prices. Maybe not a dramatic drop, but it's a sign that that plateau is starting and it'll affect everything.
I think that most of the United States is going to go through a little bit of a cycle. And once again, you got to dig into the numbers locally because it's actually going to be different even from the metro to the county to the city and possibly even the neighborhood. So dig into the numbers, number one. Number two, rent has a seasonality to it. So if it's the latter part of the year and it's around October, November, December, or the beginning of the year, January, February, that is the hardest time of the year to rent because it's nasty outside. And your rents kind of go down during that time period. So what we try to do is we try to have all of our leases popping out available in that kind of March to October range. We feel that's the sweet spot. And the even sweeter spot would be like
August.
Yeah, exactly. Like
before school starts for the
March
kids.
to September. Okay. Because that's going to be perfect. The summer months, great to rent. Right in the beginning of fall, great to rent, but it cools down naturally during the winter. So we've seen that, and what you had to expect was some natural retracement. And what I mean by that is when numbers shoot up vertically and hit a ceiling, they bounce off of the ceiling and they come down a little bit. That's a natural retracement. They then quite often will find a new floor and then project up from there. So as the real estate market in the local Seattle metro was declining in second and third quarter of 2023, you did see rent retracement in our local area. Then we saw it start to establish a floor, and it appears, this is appears because you don't know, that it is now appreciating again. Now, regardless of if it's flat or slightly down, what's going to happen to rents over the next year and a half to 2 years if rates stay high?
If rates stay high, then you could see it stay or go up because people can't afford to buy, and it's just the investors and the people that own properties that can rent it out.
Bingo. It's supply and demand. If rates stay higher for longer, which we believe that they are going to, less people qualify to be able to purchase a home. Therefore, they have to rent, which makes more demand on the rental side. So even if your market goes through some type of a lull, I believe over the next 24 months, it will go back to appreciating. I'm just saying I want you to be conservative in your number projections over the next 24 to 36 months.
Can I throw you a curveball?
Please.
Okay, so one thing I've seen multiple times, and I haven't seen this in 10 years, really since I was in real estate in the 2008, 9, and 10 era, for sale by owners. I'm seeing more for sale by owners, and what does that mean? So the question to you is, are you seeing for sale by owners? And if you do see for sale by owners, what's that a sign of typically?
Typically speaking, it's a sign of a hot market. So a for sale by owner, generally speaking, when they believe that they can sell their property and not pay a commission to a professional real estate agent, they're trying to save the money. When more for sale by owners are happening, it's because inventory is really low and the market's hot. Okay. Well, now we know the market's not as hot as it was, but the market is still hot. It's just down in transactions, but inventory hasn't risen. So you're in that seller's type of market where we are seeing bidding wars happen on good properties that are priced correctly, which creates opportunity for the for sale by owners. Side note for our investors, go hunt them. Pick up the phone, call the for sale by owner, and here's what you want to say. Hi, my name is Anton. I buy properties in the local area. What would you take for a cash offer today that closed in the next week? And then just zip your lip and listen, because sometimes you'd be surprised what they say. Second, have you thought about owner financing your property and making more money over the long run? Zip your lip, let them talk. Third, would you carry back a small portion of owner financing on this property? Fourth, would you buy down my interest rate if I was to purchase this property? Maybe you could get your rate bought back down and get their price. So with a for sale by owner, call, warm up the individual. Okay, don't just hit them blankly. Have a conversation, treat them well, treat them like a human, but then ask some good questions. That's your opportunity.
For sure. I miss being in real estate and calling for sale by owners. Because it's surprising how much they'll tell you when you care and you know a lot. And these people don't know a lot about this business and this industry, but they're doing it for a reason. And so that motivation is what you're trying to get down to, whether you're an agent or an investor. Even if you're just somebody wanting to buy, this is good information, so that you know how to approach them, because if you just kind of call and act like an asshole, you're going to get an asshole response. But if you call with like genuine, not necessarily care, because you don't want it to look like you're just puckering up to them, but you're genuinely wanting to buy and help them, man, people will tell you everything.
Bingo. And hey, if we missed something, leave us some in the comments below about things that you've done or things that have worked. Love to hear what you have to say. The reality is, though, if you're going to be an investor, you need to be hunting on all avenues, which includes the for sale by owner.
It's like being in the forest and being ready to hunt any animal that comes across your path.
Exactly.
I don't know why that popped into my mind. Okay, so this is a article that I brought up because, of course, I trust all the headlines too, right? And so you're here to correct me on any of my false information. But CNBC put out an article, and it was a tweet. Basically, it said mortgage credit availability sinks to decade low. I didn't even read the full article. I just thought that was interesting because, of course, when I hear this, I just imagine that person trying to get a loan for their house, whether it's their first home or maybe, a bigger home. They're not having as much availability of credit, meaning it's going to be harder to get approved. So what's your thoughts on this, and how true is it?
Mortgage credit availability going down is 100% true. Think about this. Let's play this out. Thank you for sending it. Totally read the whole article. But if a bank is being put under pressure because bonds have gone up and their deposits are going down, do they have more or less money to lend?
Less.
They have less money to lend. So they have less money to lend, which creates less credit availability. And we talked about this on previous episodes. We told everyone this is coming. We said there is a liquidity crunch coming. Get ready for it. And then now people are like, oh, there's a liquidity crunch starting to happen. You can see this stuff coming. It's happening, for months, but it's just now starting to show up. So when we talked about Silicon Valley Bank going under and those other banks going under, that's when we started saying, hey, this is going to start to show up as a liquidity crunch. What's happening is, according to the Mortgage Bankers Association, they measure credit availability, and they said it's the lowest level in July since 2013, indicating that lending standards have gotten even tighter. And what it is their availability for all loan types have gone down, but it went down the most in jumbo loans. Jumbo loans are your high dollar, high value loans, and we've talked about previously how that upper end of the market is going to get hit disproportionately. Those luxury homes in your market are going to get beat up, and this is just a further example. Why is it happening? Banks have less money. The Fed's looking at them more. Why would I keep my money in the bank when I could go buy a treasury and make 4.5%? So the banks have to start paying more. If they have to start paying more in interest, they have less money to loan out.
During that 2020-21 inflationary period for house prices, did those luxury homes exponentially grow in price compared to those average size homes?
Ooh, that's a really good one. We would need to dig into the stats because I don't want to guess.
Because wouldn't it make sense that those ones would have a greater amount to fall because of that? Because what's interesting is when money is available, well-off people can get access to that credit. So then they extra 100,000 whatever on a 3 million, no problem. So that just boom 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 boom, right? And so when there's less credit available, and I think this kind of brings us into a bigger conversation about the future, then what happens is, well, guess what, they already have their house, they might not need to. It's like, going from like a 5,000 square foot house to 8,000, maybe I'll skip it, right? So then what you see is all those houses either being built or people are trying to sell it. You actually see these articles. The one in LA is a good example. It's like $150 million house that just couldn't get sold. And it was like, it finally sold for like 85 million or something like that. You're just seeing these major drops. And I wonder when, I know most investors probably don't invest in this way, but there's probably a handful that are waiting for that threshold to go down enough to where they know 10, 20 years out, these luxury homes will be a huge payday. It's a little bit different because the rental income, you've told me this, like at one point, the square footage and the bedroom count, it doesn't make sense to bank on the rental income, right? It's better to like actually sell it off. But I wonder if this is something that you have clients that are looking out for, the luxury homes discounting so much where it's a steal.
We always have clients looking for a deal in all categories. So that luxury home buyer is just not quite as prevalent as it was before. So think about it. The luxury home buyer is, generally speaking, someone who either is a high W-2 earner or they own a business. Well, what's happening to business credit right now? It's shrinking. They're getting pinched. The W-2 earner, we're going through a white-collar recession right now. We see tech workers get laid off. We see financial advisors getting laid off. We see banking people getting laid off. So that's taking from those high W-2 earners too. Also, it's very different to borrow money when it's 3% versus 7%. The average home buyer buying a $500,000 house, 3% and 7%, you go, $1,000 a month. Well, all of a sudden, when that's a $5 million home, it's really crazy because that was approximately 4 times 5. That was probably 22 grand a month. And now it's probably 34. I mean, that's a huge increase. So it's just capping the top end. Now, having said that, you're still seeing little anomalies in the market where people just step up and they go, boom, cash. Location, location, location. So luxury homes, average neighborhood, may not get the price. Waterfront in our area, it's just banging.
We're not going to get more waterfront.
They're just not making more of it, you know. And
God just stopped.
Yeah. He's like, one earth. Okay, we're done. There's always a deal in any market, and it's about digging into the numbers again so you can understand, okay, is this happening in my market locally? And what part of the market is being affected? And what would be an amount I could get off of the price in order to make this a deal?
Yeah, and the bigger conversation, I think, for the future is a sign that things are starting to slow down even more, potentially could not necessarily stall out, but get to a point where, again, with a lot of uncertainty, less activity.
Yep.
More opportunity for the investor that's hungry, that's really looking out, but generally speaking, this uncertainty could lead to fear.
Yes.
And this is why you pay attention to the economy so much. Now, as an investor, you always want to be looking out for, what's a good deal right now that will last through any kinds of ups and downs. But what I'm thinking about in relation to luxury homes is be ready to keep it for a long time.
Be ready to keep 100% be ready to keep it for a long time.
It's not like a couple years ago where you could buy it and then make $1 million off the appreciation in a matter of like 1 to 2 years.
Appreciation happens in the median or the middle of the market. It doesn't always happen at the upper end. So the most appreciation, think of your natural bell curve, right? With the middle being the median, happens below the median and it moves the median up. That's why a market gets like a lower level or a lower bound in price and nothing goes below that. So here at the north end of the metro, nothing goes below 400. Like it doesn't exist. Matter of fact, I would say almost nothing goes below 500. That's even rare. And so that's the lower bound of the market. So if I'm like want to play the appreciation game, I'm actually not going to buy luxury. I'm going to buy starter homes. Instead of buying a $5 million house, I'm going to buy $5 million worth of starter homes because those starter homes are more affordable to more people. And I'm going to get that appreciation faster. Now,
and you can have multiple doors.
And you can have multiple doors. Meaning it's easy to rent.
More rental income from multiple sources.
I can lower my risk. Yes, it makes sense if you're doing this for your family, if you're doing it for a legacy, if we're doing it for emotion and fun. But very rarely are you going to be able to go buy a luxury home as an investment.
All right, we'll see you guys next week. What's the topic next week?
Unique ways to find off-market deals.
There you go. Subscribe. Comment below on what was the takeaway.